Every major financial collapse begins with the same conviction: this time is different. In 1929, investors believed a new era of industrial growth had eliminated risk. In 2008, policymakers believed financial engineering had made the system safer. Both assumptions ended the same way, with widespread losses, government intervention, and years of recovery. As 2025 approaches, the global economy faces another test, but the conditions are unlike any in living memory. For the first time, the three pillars of modern wealth, stocks, bonds, and real estate, are simultaneously overvalued and unstable. Central banks have limited room to respond. Interest rates are already high, inflation remains persistent, and public debt has reached levels that make large-scale bailouts politically and financially untenable. The numbers are difficult to ignore. Global debt now exceeds $350 trillion, roughly 4 times global GDP. The United States alone carries $36 trillion in federal debt, with annual interest costs surpassing the entire defense budget. Corporate defaults are rising, household savings are near record lows, and commercial real estate values continue to slide. Meanwhile, the same concentration of wealth that defined 1929 and 2008 has re-emerged. A handful of technology firms now account for nearly a third of the U.S. stock market's total capitalization. Financial historians call this convergence the everything bubble. It represents not just a market imbalance, but a structural one, the cumulative result of decades of cheap credit, speculative incentives, and policy dependence on ever-expanding debt. What's unfolding is not a single crisis. It's the exhaustion of a system built on the assumption that debt could grow forever. To understand why the 2025-2026 collapse is unfolding, you have to go back to 2008, the year the global financial system came closest to breaking since 1929. The crash of that era was not just a housing crisis. It was the moment when debt became the foundation of recovery. What began as an emergency measure to prevent a depression gradually evolved into a permanent economic model, one that made the next collapse inevitable. When the subprime mortgage market imploded, major U.S. and European banks were deeply exposed. Credit froze, interbank lending halted, and by October 2008, the entire financial network was one weekend away from paralysis. In response, central banks cut interest rates to near zero, and governments launched unprecedented rescue programs. The logic was clear: liquidity must flow at any cost. The strategy worked temporarily. By 2009, the system stabilized, but the recovery was artificial. Instead of addressing structural weaknesses, excessive leverage, moral hazard, and speculative finance policymakers reinforced them. Federal Reserve began its first round of quantitative easing QE, creating trillions of dollars to buy government and mortgage-backed securities. The goal was to lower borrowing costs and stimulate growth. But in practice, QE inflated asset prices while doing little for the real economy. Interest rates remained near zero for more than a decade. This period, often called the cheap money era, reshaped everything from corporate behavior to government policy. Companies borrowed heavily, not to invest in productivity, but to buy back shares and boost valuations. Governments ran record deficits without immediate penalty because borrowing was virtually free. Investors, starved for yield, poured money into riskier assets, technology, startups, junk bonds, cryptocurrencies, and speculative real estate. Between 2009 and 2020, global debt more than doubled. Every sector, household, corporate, and government expanded its balance sheet under the assumption that money would always be cheap and inflation would remain subdued. In effect, the world built an economy that only functioned under emergency conditions. The turning point came quietly in 2013, when the Federal Reserve first hinted at reducing its bond purchases a moment later, known as the taper tantrum. Markets reacted violently, revealing just how dependent global finance had become on central bank intervention. The lesson for policymakers was perverse but clear. Whenever the system showed signs of instability, print more money. The markets learned it too and began to behave accordingly. By the late 2010 seconds, this feedback loop defined the global economy. Any sign of weakness, a market correction, a trade war, or slowing growth triggered immediate expectations of central bank support. Investors stopped pricing risk accurately because they believed policymakers would never allow a true collapse. This belief, more than any specific policy, created the foundation of the next crisis. Then came 2020. The pandemic turned a fragile balance into a full-scale monetary experiment. Within months, central banks created over $9 trillion in new liquidity. Governments spent freely on relief programs and stimulus checks, pushing global debt to unprecedented levels. For the first time in modern history, fiscal and monetary expansion moved in the same direction, amplifying each other. Initially, the results looked miraculous. Markets recovered in record time, and asset prices soared. By mid-2021, the S&P 500 had doubled from its March 2020 low. Real estate prices surged worldwide. Venture capital poured billions into speculative technologies. Retail investors, armed with stimulus cash and trading apps, flooded into markets with little understanding of risk. The system appeared stronger than ever, but beneath the surface, its vulnerabilities deepened. Inflation, long assumed to be permanently subdued, began to rise in 2021. Supply chain disruptions, labor shortages, and excess liquidity pushed prices upward at a pace unseen in 4 decades. Policymakers initially dismissed it as transitory. They were wrong. By 2022, inflation had become embedded in the economy. Central banks, forced to respond, raised interest rates aggressively. What they discovered was that after 15 years of dependency on cheap money, the system couldn't withstand normal borrowing costs. Every corner of the global economy had been built around debt. Corporations carried record leverage. Governments relied on low interest payments to fund deficits, and consumers were burdened with mortgages and credit card balances at historically high levels. The rate hikes of 2022-2023 began to expose the fragility beneath the surface. Bond markets, once considered the safest part of finance, suffered their worst losses in modern history. Treasuries, the foundation of the global financial system, fell more than 20% in value, a decline comparable to equities in a bear market. Pension funds and banks holding long-duration bonds experienced massive unrealized losses. Banks failed, caught between falling asset values and fleeing deposits. Authorities rushed to guarantee deposits, but the message was unmistakable. Higher rates had broken something fundamental. By 2024, the illusion of control began to fade. Inflation slowed but remained above target, while growth stagnated. Debt service costs for governments surged, crowding out spending on infrastructure, defense, and social programs. Consumers, already stretched, began cutting back. Office towers stood half empty, their valuations collapsing as remote work persisted. At the same time, the concentration of wealth in a few mega-cap technology companies reached historic extremes. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla accounted for nearly 1/3 of the entire U. Their success masked the weakness beneath the surface. Most companies were struggling, but the market indices looked healthy because of 7 names. This concentration resembled 1,929, when a few industrial giants propped up the illusion of prosperity until the entire structure collapsed. The pattern was clear to those who studied financial history. A long period of easy money had produced structural imbalances, excessive leverage, inflated assets, and moral hazard. When central banks finally tried to normalize policy, they discovered the world could no longer function without artificial support. The seeds of the 2025-2026 implosion were already sown. The origins of this coming collapse are not mysterious or hidden. They are the logical outcome of a system that mistook liquidity for stability and stimulus for growth. Each crisis since 1987 has been met with greater intervention, each recovery fueled by more debt. The line between emergency and normality blurred until they became indistinguishable. By 2025, the cycle had reached its mathematical limit. With inflation still elevated, central banks could no longer cut rates without reigniting price spikes. Governments, already burdened by record debt, could no longer spend their way out. The system had no tools left, only consequences. That is the true origin of the 2025-2026 debt implosion. Not a sudden shock or an unforeseen event, but the accumulated weight of decades of deferred reckoning. The decade after 2010 was defined by recovery, or at least the appearance of it. Markets surged, employment rebounded, and consumer confidence returned. Politicians and central bankers hailed it as proof that the post-2008 interventions had worked. Yet underneath, something far more complex was happening. The global economy was becoming dependent on rising asset prices rather than rising productivity. The foundations of this new prosperity were not built on innovation or real output, but on liquidity. Central banks across the world, from Washington to Frankfurt to Tokyo, maintained policies of near-zero interest rates and large-scale asset purchases. Trillions of dollars in newly created money entered financial markets, searching for return. Traditional savings accounts yielded almost nothing, forcing individuals and institutions into riskier assets. Stocks, bonds, private equity, and real estate all inflated together. Between 2010 and 2020, the S&P 500 more than tripled in value, corporate bond issuance hit record highs, and global property prices climbed relentlessly. On paper, wealth soared. In reality, that wealth was increasingly concentrated and fragile. Only those who owned assets benefited. Wages, meanwhile, stagnated. The wealth gap widened sharply, creating social and political tension that would later influence the entire structure of economic policy. The rise of financial engineering became the defining feature of the era. Corporations, flush with cheap credit, found that the easiest way to increase shareholder value wasn't through innovation or expansion, it was through stock buybacks. By reducing the number of shares on the market, companies could inflate earnings per share and boost executive compensation. Corporations spent over $6 trillion repurchasing their own stock, often financed with debt. This cycle reinforced itself. Rising stock prices created the illusion of economic strength, which encouraged more borrowing, which in turn pushed valuations even higher. Financial markets became the central measure of national success, eclipsing traditional indicators like productivity, growth, or manufacturing output. Governments, too, grew comfortable with debt as a tool for political stability. Fiscal deficits no longer carried stigma. They became instruments of reassurance. Meanwhile, globalization entered a new phase. Cheap credit financed offshoring, automation, and massive corporate mergers. The global financial system became tightly interconnected, efficient in good times, but brittle under stress. Technology companies emerged as the new industrial giants. Their platforms dominated communication, commerce, and data, giving them near monopolistic power. Investors rewarded them with valuations that assumed infinite growth. Venture capital flooded into startups, promising disruption in everything from finance to transportation. A generation of investors grew up believing that markets only moved in one direction. Then came 2020. The pandemic was both a shock and an accelerant. It exposed how fragile the system had become, but it also triggered the most aggressive intervention in modern history. Governments issued debt on a wartime scale. Central banks, already the dominant players in markets, became their lifeblood. In the United States, the Federal Reserve's balance sheet expanded from $4 trillion to nearly $9 trillion in less than 2 years. Interest rates were cut back to zero, and trillions were injected directly into financial markets. The result was a breathtaking surge in asset prices. The S&P 500 hit record highs. Cryptocurrencies exploded in value, and speculative trading became a cultural phenomenon. The logic of the system was simple. As long as money was free, nothing could fail. Every dip was a buying opportunity. Every crisis, a reason for more stimulus. Governments embraced the same logic. Massive deficits were normalized under the banner of modern monetary theory, which argued that as long as inflation remained low, debt didn't matter. For a brief period, it seemed true, but the consequences were cumulative. The decade of easy credit had already stretched valuations to extremes. The pandemic response pushed them into unreality. By 2021, Global markets were priced for perfection in a world that was anything but stable. Productivity growth was flat. Supply chains were strained, and inflation, the silent constraint that economists had dismissed for a generation, began to reawaken. The first cracks appeared in late 2021. Consumer prices surged, eroding purchasing power and forcing central banks to reconsider their stance. Yet when they began raising rates, even slightly, markets wobbled. It was a clear signal that the global economy had become dependent on zero-cost money. Every institution, from governments to corporations to households, was leveraged to a degree unseen in peacetime. Still, policymakers hesitated to change course. Each small attempt to normalize rates led to volatility and fear of collapse. And so the cycle continued: more credit, more intervention, more asset inflation. The world's economic engine, once powered by production and trade, was now sustained almost entirely by confidence and debt. By 2024, this system had reached its apex. Markets stood near record highs, but the underlying economy showed signs of fatigue. Corporate profits flattened, productivity stagnated, and wage growth lagged behind inflation. It was a fragile equilibrium, one that required constant belief in the system's permanence. But belief, like liquidity, is finite. When it begins to evaporate, no policy is strong enough to replace it. That is how the rise of the post-2008 financial order set the stage for its fall. It wasn't a sudden deviation or an unforeseen shock. It was the logical continuation of a decade that mistook rising prices for progress and credit expansion for growth. By 2025, the illusion of control was fading. The very tools that once created stability, low rates, quantitative easing, and government deficits, had become sources of instability. The rise had been extraordinary, but it was built on a foundation that could not last. By 2025, the system that once appeared stable was quietly corroding from within. What had begun as a policy of emergency intervention had evolved into an unspoken agreement between markets and governments. Debt would always rise, risk would always be absorbed, and losses would always be socialized. It was a structure that rewarded short-term speculation while punishing long-term prudence. The corruption was not always illegal. It was systemic. Every major actor, corporations, politicians, central banks, and investors became complicit in sustaining an illusion they could no longer control. Markets no longer reflected the health of economies, but the expectations of policy support. Financial news became less about earnings or productivity, and more about whether the Federal Reserve would raise or cut rates by 1/4 of a point. Monetary policy had replaced fundamentals as the primary driver of value. Corporations adapted to this new reality. Debt became their lifeblood. With borrowing costs still historically low through much of the 2010 seconds, companies issued bonds in record volumes. But rather than funding innovation or production, much of this money went into financial manipulation, buybacks, mergers, and dividends. The rewards flowed to executives and shareholders, while real investment lagged. By 2023, many large firms had become dependent on refinancing their debt to survive. The line between profitability and liquidity blurred. As rates rose, this structure began to unravel. Zombie companies, businesses that could only exist through cheap credit, multiplied across industries. Many of them continued operating not because they were viable, but because liquidation would expose the fragility of the broader system. Governments faced their own form of moral hazard. Public debt, once a tool for targeted stimulus, became a mechanism for political survival. Fiscal discipline disappeared under the pressure to sustain growth and avoid recession. Both left and right found reasons to justify endless deficits, one in the name of social support, the other in the name of tax relief. The outcome was the same: rising debt, falling credibility. In the background, central banks became the ultimate enablers. They were caught in a paradox. The more they intervened to stabilize markets, the more markets demanded intervention. The result was an economy addicted to monetary support, unable to tolerate even small doses of restraint. This feedback loop distorted not only markets but democracy itself. Policy debates were increasingly shaped by what financial markets could tolerate. Politicians no longer spoke about balancing budgets or long-term planning. They spoke about investor confidence and market reactions. Governments, once sovereign over their economies, began taking cues from the very system they were supposed to regulate. Meanwhile, inequality deepened to levels not seen since the Gilded Age. The top 1% controlled more than half of all financial assets, while the bottom 50% owned almost none. Inflation, which policymakers once dismissed as a temporary side effect, became a regressive tax on the working class. As living costs rose and real wages stagnated, resentment built quietly across societies. The same forces that had stabilized markets were eroding trust in institutions. Citizens watched as governments bailed out corporations, but hesitated to fund affordable housing or healthcare. The idea that markets were efficient and self-correcting lost credibility. Populism surged on both ends of the political spectrum, united only by a common anger toward a system that seemed to reward speculation and punish work. Inside the financial world, the contradictions became impossible to ignore. Pension funds chased yield in risky private assets. Banks used complex accounting to conceal exposure to falling bond values. Regulators, fearful of triggering panic, looked the other way. Everyone knew the numbers didn't add up, that debt levels were unsustainable. Valuations disconnected from reality, but no one wanted to be the first to admit it. The conflict was no longer just economic, it was moral. The very idea of value of what money represented had been hollowed out. Prices no longer conveyed information, only liquidity. Risk was no longer something to be managed, but something to be deferred. Every correction had been prevented, every failure postponed, until the entire structure depended on the belief that it could never end. By 2025, that belief was weakening. Markets were volatile, inflation persistent, and trust deteriorating. The machine that had run for decades on credit and confidence was beginning to stall. And when a system built on perpetual expansion stops growing, it doesn't simply slow down. It turns on itself. The turning point arrived quietly, the way all great financial collapses do, not with panic at first, but with exhaustion. By late 2025, the cracks that had spread through the global economy were no longer invisible. Corporate earnings weakened, credit markets tightened, and defaults began to rise. Yet for months, investors clung to the belief that policymakers would intervene again. But this time, the tools didn't work. Central banks, constrained by persistent inflation, could not slash interest rates back to zero without reigniting price surges. Governments, already burdened by historic levels of debt, had little fiscal space left to borrow or spend. The usual playbook, lower rates, print money, bail out institutions, had been exhausted. The system was out of options and out of credibility. The first phase of the collapse began in the bond market. Long-term government yields climbed as investors demanded higher returns to offset inflation and fiscal risk. Bond prices fell, inflicting losses on banks, pension funds, and insurers, the same institutions that relied on safe assets as their foundation. For the first time in modern history, the so-called risk-free asset became the source of systemic risk. As bond values declined, the pressure spread into equities. The major indices, heavily weighted toward a handful of technology companies, began to slip. When those few leaders finally faltered, there was nothing left to support the illusion of stability. The sell-off accelerated, and the same algorithms that had driven markets upward for years began to unwind positions at record speed. By early 2026, liquidity vanished from multiple asset classes simultaneously. Stocks, corporate bonds, and real estate all fell together, the everything crash financial historians had long warned about. Commercial property markets froze, mortgage-backed securities lost buyers, and credit spreads widened to crisis levels. Companies that had survived for years on rolling over debt suddenly faced insolvency. Governments scrambled to contain the fallout. Emergency meetings were held across Washington, Brussels, and Beijing. Central banks opened swap lines and liquidity facilities. But the problem was not a lack of money, it was a loss of confidence. The global financial architecture, dependent on continuous refinancing, had entered a self-reinforcing spiral of deleveraging. Banks became reluctant to lend even to one another. Sovereign debt markets grew unstable as investors questioned whether governments could continue servicing their obligations at higher interest rates. For countries with large external debts, from Italy to Japan to emerging economies, the stress became existential. In the United States, the Treasury faced its own reckoning. Annual interest costs on federal debt surpassed $1 trillion, consuming a growing share of tax revenue. Political paralysis made decisive action impossible. Each new stimulus proposal met opposition from those warning of inflation. Each austerity proposal risked deepening the downturn. What made this collapse different was its universality. In previous crises, investors could flee to safety to government bonds, cash, or real estate. In 2025, 2026, all three were compromised. Bonds fell with equities, inflation eroded cash, and property values declined. The old hedges no longer worked. Diversification, the core principle of modern finance, failed. The consequences extended beyond markets. As asset prices fell, consumer confidence collapsed. Job losses mounted, especially in construction, finance, and technology. The wealth effect that had sustained spending for years reversed violently. The political consequences were immediate. Populist movements gained momentum, and trust in institutions already fragile began to break down. Yet amid the destruction, a transformation was taking place. Policymakers and economists, forced to confront the limits of perpetual debt expansion, began rethinking the foundations of the global system. The era of easy credit and infinite liquidity had reached its mathematical and moral endpoint. For the first time in decades, the question was no longer how to grow faster, but how to rebuild something stable. It would take years, perhaps decades, to find that answer. But one truth had become undeniable. A society cannot sustain prosperity built on the assumption that money will always be free and risk will always be managed away. The collapse of 2025, 2026 was not an accident. It was the delayed accounting of choices made long ago and the moment when the future finally came due. When the dust settled, what remained was not just financial ruin, but an intellectual reckoning. The collapse of 2025, 2026 did more than destroy wealth. It shattered an entire worldview. For half a century, advanced economies had operated on a single assumption: that debt, if managed carefully, could replace real growth. That illusion no longer survived. The first lesson was mathematical. Debt had outpaced the productive capacity of the global economy by a margin too great to conceal. In previous eras, policymakers could stimulate demand through borrowing because growth eventually caught up. But by the 2022s, debt creation had become detached from output. Every dollar of new debt produced only a fraction of a dollar in real growth. When interest rates rose, that imbalance became fatal. The second lesson was institutional. Central banks, once seen as omnipotent, were revealed as human-constrained, fallible, and political. Their tools could delay crises, but not eliminate them. Years of quantitative easing had blurred the line between monetary policy and fiscal policy, leaving central banks politically exposed and technically exhausted. When inflation surged and markets fell simultaneously, the illusion of control dissolved. The third lesson was social. The belief that asset inflation equated to prosperity collapsed under its own contradictions. Decades of rising home and stock prices had benefited the top decile while leaving most households behind. When the cycle reversed, it was the middle and lower classes, those without financial cushions, who bore the brunt of the fallout. The public's trust in financial institutions, already eroded after 2008, fractured entirely. In the aftermath, governments were forced to confront uncomfortable choices. Some chose restructuring, painful austerity, and targeted debt forgiveness to restore solvency. Others turned inward, embracing capital controls, nationalism, and currency reform. Globalization, once the organizing principle of modern economics, began to retreat. Supply chains shortened, trade blocs hardened, and the free flow of capital slowed. What emerged in the late 2020s was a world more fragmented, but also more cautious. Nations that had long relied on endless credit turned to tangible investment infrastructure, manufacturing, and energy independence. The speculative excesses of the previous era gave way to pragmatism. In the United States, a new generation of policymakers debated whether the Federal Reserve's dual mandate, price stability and employment, should include a third: financial stability. But the deepest legacy was psychological. The myth of perpetual safety that governments could always print or borrow their way out of any crisis had died. People began to think differently about money, savings, and risk. Balanced budgets, once dismissed as relics of an older era, returned to the conversation. Still, the cost of the lesson was immense. Millions lost homes, pensions, and businesses. Retirement systems strained under the weight of failed assumptions. Trust, the most fragile form of capital, took the longest to rebuild. Yet from that loss came clarity, a recognition that financial stability cannot be engineered through manipulation, but must be earned through balance between credit and production, policy and restraint, ambition and humility. Historians will one day describe the 2025-2026 collapse as the end of the debt supercycle, a century-long experiment that began when money was untethered from gold and ended when the belief in infinite leverage met the limits of reality. It marked the transition from an age of expansion to an age of consequence. If there is a single moral, it is this: when a society builds its prosperity on promises it cannot mathematically keep, the reckoning is not a question of if, but when. The collapse was not the failure of capitalism, but the failure to respect its boundaries. The age of borrowed time had run out. What followed would not be a return to the past, but the slow rediscovery of value, real, measurable, and earned. The 2025-2026 debt implosion. Systems built on debt without discipline will always collapse. Not from surprise, but from inevitability. Thank you for watching this video. Click here to watch another video that might interest you.